Today we got a new neighborhood and we got new interest rates thanks to the Federal Reserve. Obviously today's Wednesday when I'm shooting this, and the Fed decided to go ahead with their rate hike at a measly 1/4 of a point. If it were me, I would have hiked it higher. As we know, inflation is raging out of control, and a 1/4 point is basically a blip on the radar at this point, if you ask me. But hey, at least they're going in that direction. You know, the last thing we wanted to see is them pause and do nothing. That would be devastating for our economy. And by the way, I said new rates and new neighborhood. This is Sans Souci Estates over here in Miami. And let's take a look around here, guys. I've never been here before, never even driven through here. So we're just gonna walk around, see what this place is like. Now here's the interesting thing. The Federal Reserve decided to go ahead with the rate hike, but they actually removed a line from their statement about ongoing increases. It leaves people to wonder how many more rate hikes are there going to be in 2023. However, I still think that they're going to have to continue with rate hikes for quite some time, regardless of these bank failures, because Powell came out and said, you know, the banking system is fine and, you know, we're going ahead with these rate hikes. But as you can see, it's only a 1/4 point, guys. And in reality, we need these rate hikes to be much higher than they actually are. And some people are wondering how serious the Fed even is at this point about fighting inflation when they just printed this $300 billion to help the banks out, and at the same time saying that they're worried about inflation. You know, you can't really have it both ways, because printing all this money is inflationary, not deflationary. Remember how the other day we talked about this proposal from the hedge fund manager Nelson Peltz about guaranteeing all bank deposits from now on and basically making the FDIC insurance amount unlimited? Well, I think there are a couple of holes in his idea, but overall, it's a good idea to provide safety and especially confidence in our banking system when basically all of that is completely broken right now. Well, genius Janet Yellen also steps forward today and says that they are not considering raising the FDIC insurance limit above the $250,000, okay? She said that's not something we've looked at. This is not something we are considering. Well, why not? You guys just bailed out Silicon Valley, Signature, and whatever other ones that I already forgot the names of, and gave them unlimited amounts of money back. So why aren't you looking at guaranteeing the safety of all these other banks? You know? Give us one good reason why. And of course, she doesn't have one. She just said that during a contagious bank run that the Treasury would likely pursue an exception that would permit the FDIC to protect all deposits. This would be considered on a case-by-case basis. And of course, after she said something this ridiculous, that caused stock prices to go down, because it doesn't really paint a picture of confidence in this economy when they're basically in the Treasury Department saying, yeah, well, we'll help who we feel like when we feel like it, and that's pretty much it.
Now this house is the perfect example of people that list the house for sale and then take it off the market thinking, well, we'll have better luck next year. Well, they tried listing it for sale a year ago, guys, for the same price basically that they tried for this year, $2,195,000. They lowered the price. Now it's down to $2,150,000, and they have it listed for rent at $8,250 per month and no takers. So I don't know how long places like this need to sit empty for people to really get the hint.
And speaking of interest rate hikes, this is just going to propel the housing market crash. In fact, this week, the National Association of Realtors finally came out and acknowledged that we have now seen the home prices fall year over year since the first time since 2012. And I was just wondering and waiting to see when they were going to finally come out and admit this, because anybody that follows my channel closely, we talked about this a little over a month ago whenever January's numbers were in, and they were basically saying how home prices are up year over year and everything is great with the housing market. Well, guess what? They can no longer say that, and I was just dying to see what their new narrative is going to be once they can no longer hide from the home price declines. Because now that it's fallen year over year, guys, well, that's only part of the story, okay? Because even according to their data, since June of last year, the home prices have fallen 12.3% on a national level. And that's from the National Association of Realtors, okay? And guess what? That's only about an 8-month time span that prices fall 12.3%. Point to another time, show me another time in history when we have seen home prices fall this much, that fast. Oh wait, you can't, because it never happened before. This is the first time ever. And so the Fed just raised interest rates only by a quarter point, not that much, but this is very likely to push mortgage rates even higher, which I'll talk about that in just a minute. But here's the interesting thing about this report from the National Association of Realtors. Economists now are expecting that home prices are going to continue to fall throughout this spring. And there's too many headwinds facing the housing market in the way of affordability and higher interest rates for mortgages. Now, more and more economists are starting to get with the program and realize that the situation that we have right now with the real estate market is completely unsustainable, and it's all coming to a screeching halt right now. And the only thing right now, guys, and I am telling you, and you can go look at this article for yourself, the only thing that is preventing home prices from completely plummeting right now is low inventory. And it's not like inventory is super low. We're almost at pre-pandemic levels, but we're not quite there. But here's the thing, it's been on the rise. Inventory has been going up. And as the market just continues to stall out due to affordability and high mortgage rates, you're gonna see inventory continue to creep up, because obviously people need to sell. There are people that need to sell no matter what's happening in the world. Those houses are coming to market. And the only thing that's stopping the market from dropping, a couple percentage points per month at this point is low inventory. That's it. If we see an uptick in inventory this spring, like we've seen basically every year in history, then that's going to be the last thing that pushes this housing market over the edge. That's finally going to push things in the favor of buyers. And check this out, just like I have been saying, this is a worldwide issue. This is not something that's just happening here in the US. We know that things have really come down in Canada, okay? But it's also happening over in the UK, it's happening in Germany, it's happening in the Netherlands, it's happening in Australia. All these places are seeing huge decreases in home prices, especially Sweden, guys. So this is a worldwide phenomenon right now. This is not exclusive to the US. And that's how we know that there are big problems with the worldwide economy. It's basically everything is shifting in a new direction. You have globalization somewhat coming to an end at this point, because we have this new formation of the BRICS nations that are getting ready to cut the US out of their economy. Okay, they're tired of the games that we play with the funny money, and who can blame them? It seems like to me that the pandemic just kind of pushed everything in a new direction, and that was just like the last nail in the coffin that we needed to kind of push everything over the edge. It broke the supply chains, it broke the housing market, it broke the economy as a whole, and now we're starting to see the repercussions from it. But some home buyers are just so desperate and just don't get the hint that, and it's reflected in the data, because check this out. As the mortgage rates went down, okay, you had a bunch of people pile back in and apply for new mortgage applications. Last week, the 30-year rate was at 6.7. Now it's down to 6.48, and that tiny little drop in rates was enough to make mortgage applications go up by 3%. Now 3% is not a lot, but it just goes to show you the desperation of some people that just cannot handle the mental agony of not getting a house right now, which is kind of sad if you ask me. Because at this point, I feel like people who are doing this are just laying it all on the line and willing to risk everything just to get into a home, and for what, guys? For the possibility of losing your job over the next several months, the highest interest rate that anyone's paid in the last 30 or 40 years, close to all-time high home prices still, and making someone else rich? Like, what's the motivation here? I just don't get it. You're seeing the mortgage applications go up 3% at a time when rates are still very high, very close to 7% for a lot of people, because most people don't have the credit and the income to qualify for this 6.5% rate. And on top of that, you're seeing banks fail week after week, and the Fed just came out and raised interest rates again. Is this a desperate attempt for people to lock in a lower mortgage rate now before more interest rates come? I don't know. I don't know what people are thinking, but if this is you, let us know, so that way people can get an idea of what's going through everyone's mind right now, because the psychology just doesn't add up. Because people need to understand that the only reason that mortgage rates have been going down is because the yields on the 10-year Treasury have been falling, guys. And the reason the yields on the 10-year Treasury is falling is because investors are spooked, okay? That's the reason why the 10-year Treasury yields have been falling, okay? People that invest in this are completely scared out of their wits right now that more banks are going to fail and the stock market is going to fall off a cliff. But yet, you're out there applying for a mortgage. So please let us all know what's going on in your mind, because I'm sure we'd all love to know at this point. And like I've been telling you guys, that just keeps continuing to come true, that all of this is going to continue to deteriorate and get worse. Well, here is the latest thing that is going to basically pour fuel on the fire. Because we have this huge trend in remote work, right? People are spreading out across the country and living and working from home in places that they normally couldn't just a few years ago. Well, the impact that this is having on commercial real estate is tremendous. So much so that it's to the point where some commercial mortgage-backed securities are at risk of default right now because so many companies are letting go of their office space.
This house isn't for sale or anything, or at least it doesn't seem to be. I just thought it was interesting to show something that's falling apart and dilapidated in a pretty nice neighborhood where everything else looks pretty tip-top. Just thought it would be interesting to show you guys what's going on out here.
Now, I'm not speaking for or against remote work here. I'm just letting you guys know the facts, that this is what's happening as a result of this. So here's what's happening. Lenders' anticipation of lower office revenue is creating refinancing difficulty for office loans with low debt yields and loans with significant lease maturities in the next 36 months. But here's the problem with this. Because so many companies are letting go of their office space, the lease rates for these office buildings is falling, and because the price to lease these office spaces is falling, it's making it harder for businesses to pay back their loans on these commercial real estate properties. And that's why this is increasing the risk of defaults. Now, the good news here is that a lot of the potential defaults are still 36 months away. And for those of you who are counting, that's 3 years from now. But the problem is, guys, like, look at all the issues that we're having right now with the banking crisis and with the housing market starting to do a 180 and the economy entering the official recession any day now. Well, this is going to come at a time when maybe we're just starting to recover from some of that, and then wham, you get all these office defaults because people are moving out. You know, there's no demand to have office space anymore. And what's going to happen then? Now, don't get me wrong. I don't lose sleep over any of this, okay? You know, none of this keeps me up at night wondering, oh, what's going to happen in 3 years from now whenever companies can't make their lease payments or their mortgage payments on the office. That doesn't worry me. But I always like to think ahead, because when you're able to think ahead and look at what could be potentially coming down the road, it helps you make better decisions today, especially when it comes to any type of investment. And this could spell more problems for companies in the future. If companies are letting go of office space, then they ultimately might not need as many employees, which could lead to more layoffs in the future, as well as the fact that when you look at this, guys, the office revenue has already fallen 10% below where it should be at this point, given where the unemployment numbers are. I think as more companies start to get rid of this office space, they're also going to start getting rid of more people too. because yeah, sure, they're going to have people working remotely, the ones that are embracing remote work. But remember, as a remote worker, they can hire remote workers from anywhere across the world. And why are they going to pay someone here, you know, triple or 4 times as much as somebody they could pay overseas to do the same job? So that's something else you got to think about with this. And out of the 25 largest office markets where there's the most office space in the country, San Francisco had the highest increase in vacancy rates at 13.5%, which is the sharpest drop in asking and taking rents, down 13% and 31% respectively. So basically, renting an office in San Francisco right now is at 2014 levels in terms of pricing. So now's a great time to set up shop in San Francisco, as long as you don't mind 100 tents outside your front door and people coming in and stealing $900 and whatever worth of merchandise without getting arrested. So if you want to deal with that, go ahead and open up a store in San Francisco. But what this is I think it's a reflection of where things are going in general, because it's not like everything is falling across the board everywhere. Because when you look at Charlotte, North Carolina, this area is the polar opposite of San Francisco. They saw the most significant growth in both asking and taking rents, up 9.5% and 6% respectively. So people are closing shop in San Francisco and opening shop in Charlotte, North Carolina. And I don't think that's a coincidence when you look at how different these places are in terms of how things are operated. You're not going to walk down the streets of Charlotte, North Carolina and see 100 tents in front of a brand new business, okay? Now here's something for my Canadian friends and viewers. I just read today that in Canada, they're saying that for the first time in a while that hourly wages have increased at a higher rate and faster rate than inflation in Canada. Now, first of all, do you believe this as a Canadian resident, that that is actually true? Because here in the US, if they were to say something like that, I'm pretty sure most people would realize that that is a flat out lie, because inflation is still higher than the amount of wage increases that people are getting. But according to this report from Canada, they're saying that wages went up 5.4% from February of 2022. So in the last year, they went up 5.4%, and they're claiming that that is more than the rate of inflation in Canada. Do you think this is true? Because they're also pointing to this. They're saying that oil and natural gas prices are at their lowest level since the spring of 2021, but in reality, even though that's good for people's bottom line and their weekly paychecks, it's a bad omen for the economy overall, because it means things are slowing down. This is what they said over there, your officials in Canada. They said, we are confident that inflation will fall below 3% this summer, which is supported by a continued moderation in the goods components. This is from the National Bank of Canada saying this. So what do you guys think? Do you think this is true? Do you think your Canadian officials are telling you how it is over there? I mean, this all sounds like insanity to me, and I don't even live there. Because I guess over there in Canada, your central bank decided to pause the interest rate hikes instead of move forward like they did in Europe and like they did here in the US. And so they're saying, because everything is coming down in price, especially commodities over there, that, you know, we're going to have inflation squashed by this summer. So what do you guys think? You think that's going to happen?
Here's one for you. This house has been on the market since August of 2022, and they were asking a whopping almost $6.5 million, and now they have cut the price basically $550,000 down to $5.9 million, but still no takers, because it's been that price since October 2022, and here it lies. So I don't even know what else to say about these places at this point. You guys can form your own opinions about it.
This is also why I said in an earlier video that watch what they do, not what they say, because this is all a bunch of fancy talk right now to try and make everybody think that all the problems are soon to be over with, when in fact they're just getting started. And I think that's a dangerous narrative to believe in right now, because the problem with that is it makes people go out and spend like there's no tomorrow, because they think that their job is going to be secure and that they're going to be able to pay back all the debt they're getting themselves into, which just might not be the case. Check this out, guys. Someone really crunched that gate. Looks like the movies where somebody rams the gate, you know? Crazy. But once again, I'd rather plan on getting hit really hard with a really tough recession and have the finances and the resources to back that up than believe all these people and just go out there and start spending like a drunken sailor, put everything on the credit card, get into debt, be one of these people clamoring for the mortgage applications and just go out there and spend, because that's what they want you to do, because that's their solution to fixing this problem. They think if enough people go out there and spend like there's no tomorrow, that that's going to be enough to fix everything. But the reality is the problems are so deep and so systemic that no matter what happens, I think it's all going to have to just fix itself, guys, because one thing's for sure that we can see is no matter what they do, the problems continue to mount. You know, regardless of the interest rate hikes, the bank failures, everything, it's all just continuing to fall apart regardless of what the officials do. So, rather be safe than sorry. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I post a new video. And if you don't want to wait, check out my next one on the screen right over here, and I'll see you in the next one.